Hello and welcome to the second quarter 2024 investment update for San Diego Foundation. I'm Matt Fettig, Chief Investment Officer of the Foundation. The economy has been mixed lately, really as a result due to rising unemployment in the face of falling inflation. The Fed is now at kind of an inflection point in interest rate regime. As you know, rates have been rising for the better part of the last couple of years. We've now taken a pause, and very likely as of this September Federal Reserve meeting, we'll see our first interest rate cut. The question, of course, is the economy slowing? How much is it slowing by? And is the Fed up to date with policy to adjust for that slowing economy? And can it prevent what could be a recession to come? Let's take a look at our endowment portfolio now. You can see that the second quarter was a positive quarter for the stock market, but once again, it was driven by a handful of stocks, primarily in the technology and telecom areas, that have been significant drivers of market performance over the last year and a half. As a diversified investor, we just can't own enough of those particular names, many of them driven by this theme that we've exhibited in artificial intelligence. We have been overweight US stocks. That is the best place of any asset class to be. But we've been held back in other areas of the portfolio. Our private markets exposure, which was one of really the best places to be over the course of the last 5 years, has really slowed down with transaction volumes in the private markets, though we're starting to see some evidence of that picking up again. The largest outperformer was our real estate exposure, and you might think that very odd, as you know that real estate has had quite a bit of difficulty lately. The endowment portfolio owns primarily industrial and multifamily assets. Those have been the best performers within real estate. Meanwhile, you've had areas like office. Future of office is very uncertain. Prices are down significantly. Fortunately, we've avoided those areas. However, looking at longer term performance for the endowment, results have been very strong, particularly over 3, 5, and 10-year periods. We continue to outperform our policy index, which is the benchmark for the endowment portfolio, and results have largely been driven by those private market assets, even though they've been weak as of late. Let's move on to the long-term portfolio. The long-term portfolio underperformed its benchmark slightly over the last quarter in the 1-year period, but you can see results remain strong over 3, 5, and 10-year periods. The portfolio was overweight US equities, which is the best performing asset class out there as of late. But slightly underperformed in non-US stocks as well as emerging market stocks. Over the long term, the fixed income or bond category has continued to really lead the way in terms of outperformance, and that's really been the result of the managers that we are using in that portfolio. Performance for those managers has been very strong over those long-term periods. Next, we'll look at the medium-term portfolio. You can see over the 1-year period up 7.4%, a very strong number even relative to longer term history. Remember, this portfolio is about 70% exposed to bonds, short and intermediate term bonds. And during this rising interest rate regime we've seen over the last couple of years, bond prices have fallen, and that's resulted in some difficult performance. As the rising rate regime may now be over, interest rates may actually begin to fall should the Federal Reserve begin to cut short-term interest rates. We have the ability to generate some fairly strong yield in this portfolio. Next, we'll look at the intermediate term portfolio. Remember, this is 100% short and intermediate term bonds. There is no equity allocation within this portfolio. This portfolio was a victim of the rising rate regime we've had over the last couple of years. That appears to be reversing. The portfolio now has over a 3-year track record, and it's outperformed It's policy index due to exposure to some great managers, though you can see the 3-year number is negative. We hope this will change as the Federal Reserve begins to cut short-term interest rates. The short-term portfolio, it consists 100% of money market exposure. So unlike the medium-term and intermediate-term portfolio, the rising rate regime over the last couple of years has really helped increase the yield of this portfolio. You can see over the course of the last year, the yield of 5.4%. Now, should the Federal Reserve begin to cut interest rates in the near term, we would expect that yield to fall commensurately. And next we'll cover both the sustainable endowment and sustainable non-endowment portfolios. These portfolios suffered in performance, you can see the 3-year number, largely due to the fact that we had a global equity manager that was dramatically underperforming. That equity manager was replaced earlier this year, and performance has actually been quite strong. Over the 1-year period, up 12.4%. This is our best performing portfolio across San Diego Foundation, and the new stock manager should continue to do quite well over time. For more information, certainly contact our donor services team, or you can find more information at our website, sdfoundation.org. Thanks for joining us today.